I guess it's easier to focus on the bankruptcy side of that coin. Companies don't go bankrupt if they don't have a lot of debt. And typically they don't go bankrupt if they're generating reasonable amounts of free cash flow, such that if they do have debt, they can service their debt. So first and foremost, the strength of the balance sheet is important. And also their position relative to their peers is also very important. Depending on what you're doing, if you provide a service, if you have some competitive advantage, typically you have a much better chance of staying solvent, certainly for longer, than someone without that competitive advantage. If you manufacture something or mine something and you're low on the cost curve and you can do it more cheaply than your neighbor, then you're less likely to go bankrupt if people need those products. And of course, the stock market is likely to help you through periods of underperformance and cyclical headwinds, should you find that your balance sheet is too stretched and need extra capital. But yeah, so I suspect that what feels like the companies that have a competitive edge in whatever they do are the ones that are less likely to be bankruptcy candidates than those that aren't competitive in what they do, irrespective of what the balance sheet might look like. I mean, PE ratios in principle make a lot of sense and they feel good, but they don't work so well when there's no E and the companies make no earnings. And most of the companies that we are attracted to are companies that are at a point in their economic cycle or where earnings for their entire sector are hard come by. The energy companies not so long ago, when energy prices or oil prices fell to the $30, not many oil companies made any profit. And so you could pay 100, 200 times earnings or negative PE multiples for these companies, but that's not normal and it's not sustainable. And so often, and some of the best companies we've invested in have been companies we've invested in at very high PE multiples at the time of the investment, but the earnings have been very depressed. And if you recalibrate that to what a through the cycle earnings might look like for the company, they've been at very attractive PE multiples.